Two high-income professionals each made $900,000 last year. One wrote a check to the IRS for nearly $300,000. The other invested in real estate and legally reduced that tax bill by six figures. Same income, same tax code, completely different outcome. So why do some people with the same exact income pay hundreds of thousands of dollars in taxes while others legally pay almost nothing? It's not because they have a secret accountant. It's not because they're hiding some money in some offshore account. And it's definitely not because they're breaking the law. They're actually using a part of the tax code that most high-income professionals have never even heard of. It's called cost segregation. And when you combine it with the right real estate investment, it has the potential to create massive deductions in year one instead of waiting decades. And the crazy part, many physicians, executives, business owners spend their entire careers overpaying taxes simply because nobody ever explained how this works. So in this video, I'll show you exactly what cost segregation is, who can actually benefit from it, the biggest misconceptions that keep people from using it, and a real example that could completely change about how you think about investing in taxes. Because once you understand the strategy, you'll never look at a rental property the same way again. Make sure you subscribe to our channel. We're teaching you how to stop trading your time for money and how to create generational wealth. First, let me tell you who this is for. This strategy is for anyone if you're earning over $200,000 a year, whether that's from a W-2, a business, or a combination of both. It's for you if you own investment real estate or you're seriously considering buying some. And it's especially for you if you're sitting in the 32% or north federal tax bracket and feeling like there's nowhere left to turn. According to the IRS, the top federal tax rate in 2026 is 37% for individuals earning over $640,000 or married couples over $768,000. That means that for every dollar you earn above that threshold, you're sending 37 cents straight to the government before state taxes. Now, let me bust a myth right here. Most high earners believe that the only way to reduce taxes is to max out a 401k, maybe do a backdoor Roth, or hire a CPA who finds a few extra deductions. And look, those things do help, but they barely move the needle when you're earning at a higher level. The real lever, the one that wealthy investors use to create massive, completely legal tax deductions, is real estate depreciation. Specifically, accelerated depreciation through something called a cost segregation study. Here's the core idea. When you buy a rental property, the IRS allows you to deduct the cost of the building over time. For a residential property, that's 27.5 years, and commercial, 39 years. So on a $1 million property, you get roughly $29,000 a year in depreciation deductions. That's helpful, but it's slow. Cost seg changes the math entirely. Instead of treating the whole building as one big asset, the cost seg study breaks down the components into individual little components. Things like flooring, the cabinets, appliances, specialty lighting, landscaping, driveways, and even the fencing. These items don't need to depreciate over 27 or 39 years. The IRS allows them to depreciate over 5, 7, or 15 years instead. And here's where it gets really powerful. Thanks to the One Big Beautiful Bill Act, which was signed into law last year, 100% bonus depreciation has been permanently restored. That means any component that qualifies for a 5, 7, or 15-year depreciation schedule can now be deducted fully in year one, not spread over years, not phased in slowly, all of it right now. Let me walk you through exactly how this works in practice, step by step. Step one is identifying the right property. Cost segregation works best on properties with a depreciable basis above $500,000. Ideally, you want to be at $1 million or more to maximize the return on the study itself. This can be a short-term rental, a long-term rental, a multifamily, a commercial property. Step two is commissioning the cost segregation study. You hire a firm, typically a team of engineers and tax professionals, to physically or virtually inspect your property and reclassify all of its components. Depending on the property, a study typically costs between $1,200 and $15,000. On a standard investment property in a $1 million range, expect to pay $5,000 to $10,000 for the study. Step three is where the math gets interesting. Just to use a real example, you purchase a $1 million residential rental property in the year 2026. The land is worth $200,000, so your depreciable building basis is $800,000. Without a cost seg study, you get roughly $29,000 per year in depreciation. And at a 37% tax bracket, that saves you about $10,700 in taxes in year one. Now, with a cost seg study, let's say the engineer identifies 28% of your building's basis, that's roughly $224,000, a short-lived personal property and land improvements. Under 100% bonus depreciation, you deduct that entire $224,000 in year one. Add in the regular depreciation on the remaining building basis, and your total first year jumps to nearly $245,000. At the 37% bracket, that's roughly $90,000 in tax savings in a single year. That's an $80,000 improvement over doing nothing. From one study that costs you $5 to $10 grand. The return on investment is extraordinary. Now scale that up on a $3 million commercial property. A cost seg study commonly generates $120,000 to $180,000 in first year tax savings. On a $5 million building, first year savings are $300,000 to $500,000 or more. Step 4, and this is critical, is making sure you can actually use the deductions. This is where most people get tripped up and where a lot of bad advice circulates online. So let me be completely clear with you. By default, rental real estate losses are considered passive under the IRS under Section 469, and that means that you can only offset passive income, not your W-2 and not your business. But there are two important exceptions. The first is the short-term rental loophole, which many of you have probably heard of. If your property's average guest stay is 7 days or less, think of Airbnb or VRBO, and you materially participate in managing it, the IRS does not classify it as passive. It actually classifies it as active. And this whole cost segregation study applies to that. You can actually offset W-2 income directly. And according to Bigger Pockets, on a $500,000 short-term rental acquisition, a cost seg study typically identifies $100,000 to $135,000 in accelerated components. And for a household in the 37% bracket, that's approximately $50,000 in tax savings in year 1 alone. The second path is something called real estate professional status, or REPS, which we covered in another video. To qualify, you or your spouse must spend more than 750 hours per year in real estate activities, more hours in real estate than any other profession. So if a non-working or part-time working spouse can qualify for it, all rental losses, including these massive cost seg deductions, can offset the high earning spouse's active income. No cap, no limit. Step 5 is engaging with a CPA who's qualified and has a familiar background in real estate. This strategy is not someone that you want to run with a general accountant or someone who doesn't know what you're talking about. The documentation matters. Get the right team around you before you even think about closing on a property. Now, let me address the concerns I know you're thinking about. What about depreciation recapture when I sell the property? And this is a real consideration. When you sell the property, the IRS taxes back the depreciation you took, but typically at a 25% recapture rate. But here's the key insight. You got to use those deductions now at your 37% marginal rate, and you pay them back later at 25%. That's a meaningful spread. And many investors even use something called the 1031 exchange to defer recapture indefinitely when they roll the profits to a new property. So it works synergistically. Am I going to get audited? Cost seg is a fully legitimate IRS recognized tax strategy. The IRS even has its own cost seg audit technique guide. The key is using a qualified engineering firm that produces a defensible report. A proper full engineering study, the kind that includes in-person site visits and detailed documentation, is considered the gold standard for IRS defense. This is not a gray area. This is the tax code working exactly as Congress intended. What if I can't use the losses right now? If you don't qualify for REPS or the short-term loophole yet, the losses don't disappear. They actually carry forward. They can offset future passive income from other rental properties, or they release entirely when you sell the asset. So even if you can't use them today, they're building up on your balance sheet like a tax savings account. Now, let me paint you a picture of what consistent application of this strategy looks like. Imagine it's 5 years from now. You've acquired 3 properties using this framework. Each time you ran a cost seg study. Each time you front-loaded massive deductions in year 1. You've legally sheltered over $400,000 in income from federal taxes across 5 years. That's money you kept, reinvested, and compounded instead of sending to the IRS. That's not a fantasy. That is a documented, repeatable outcome that high-income investors are achieving right now in 2026. And the one big, beautiful bill made 100% bonus depreciation permanent. The window is wide open. The question is whether you're going to walk through it. If this resonated with you and you're serious about building long-term passive income while legally reducing your tax burden, I want to make sure that you have the tools to actually take the next step. Head over to rei.com, and when you get there, you'll find 2 free ebooks that you can download immediately. They're packed with practical, actionable guidance that covers everything that we talked about and more. You'll also get access to a free 9-part passive investing masterclass that I created for you. The things that I wish I had on day one. I walk you through the exact framework that many investors use to build long-term passive income through real estate, step by step, in plain language without the fluff. This is specifically designed for busy professionals, doctors, engineers, executives, business owners, people who want conservative, long-term passive income without quitting their jobs or becoming full-time landlords. It's completely free. No credit card, and there's no catch. Everything you just learned in this video is the beginning of a much bigger picture. The passive investing action guide is where that picture comes into full focus. So if you're serious about keeping more of what you earn and building a real lasting wealth through real estate, then go grab those free resources. And if you want to go deeper on how the short-term rental strategy specifically works to unlock these deductions, I've got a full breakdown in our next video. I'll see you there.